Twilio beat Q2 2026 consensus across the board. Earnings per share came in at $1.47, crushing the $1.32 estimate.
Oh, and revenue hit a record $1.58 billion versus the $1.43 billion estimate.
Right, and guidance was raised too. Management bumped full year 2026 reported revenue growth to a range of 18% to 18.5%.
Yeah, with organic growth bumped up to 13% to 13.5%.
This stock reaction was just, I mean, it was violent in the best way possible for shareholders.
Absolutely. Shares surged 16% in after-hours trading.
And eventually they closed up around 25%, trading near $241 to $253, which is hitting new multi-year highs.
You know, the market was really hunting for any sign of weakness in cloud communications given the broader software slowdown.
Right, totally.
But instead, they got a blowout quarter that fundamentally alters the narrative around this company's profitability profile and their core growth engine.
I mean, imagine looking at your portfolio and seeing a 25% single-day pop, not because a company announced some speculative new AI model, but because they finally proved they can stop bleeding cash.
And actually grow their core business at the same time?
Exactly. So today we are going to tear into exactly what drove that $1.5 billion beat. We need to look at the hidden distortions buried in their headline JAP numbers.
Because there's definitely some noise in there.
Oh, tons of noise. And we have to figure out if their pivot to what management is calling the agentic era of AI actually justifies this massive multiple expansion.
Right, because a top-line beat looks fantastic on a screen, but you really need to know if the revenue quality is durable.
So, okay, let's unpack this. When you look under the hood at that revenue quality, the headline growth of 22% is a bit deceptive, right?
It is, yeah.
Yeah.
But the underlying engine is actually running hotter than people realize. I mean, organic revenue growth accelerated to 17%.
Which is huge.
Yeah. For a platform operating at Twilio's massive scale, organic acceleration is like the ultimate vital sign. It proves they aren't masking stagnation by just acquiring smaller companies.
Right. The core product suite is generating its own momentum. But I'm looking at the product breakdown, and the math on that momentum feels, I don't know, a little skewed. We have software add-ons up over 25%.
Yep.
Their Verify product, you know, the two-factor authentication tool, accelerated past 30%. Voice is up over 20%. But then you hit the behemoth, which is messaging.
Ah, right.
Messaging revenue was up 28%. Now, 28% growth on your biggest product sounds like an absolute home run.
It really does.
But like about 10 points of that growth came entirely from incremental U.S. carrier pass-through fees.
Right, the A2P fees, or application-to-person fees. This is where the telecom carriers essentially charge a toll for businesses to send automated texts over their networks.
It's like, okay, think about it like ordering from a food delivery app. Let's say the city government suddenly mandates a $3 gig worker fee on every single order.
Okay, yeah.
The delivery app collects that $3 from you and hands it straight to the driver. The app's total revenue technically goes up by $3 per order, but
Well, they aren't actually selling more food.
yeah, exactly. And they aren't keeping a single cent of that extra money. That's what Twilio is doing with these A2P fees. They recognized $71 million in incremental carrier pass-through fees this quarter.
And they make zero margin on that money.
Zero. So is this 20% messaging growth just, you know, empty calories inflating the top line? Is it just a sugar high?
Well, it is entirely empty calories on a gross profit basis, which is why stripping those fees out is so critical for your analysis.
Right.
Because if you remove that $71 million completely, Twilio still delivered that 17% organic growth.
Wow. Okay.
Yeah, the actual volume of texts being sent, voice calls being routed,
Yeah.
and user logins being authenticated, all of that is expanding at a double-digit rate.
And the mechanism proving that volume growth is really their dollar-based net expansion rate, right? Their DBNE.
Exactly.
Which jumped to 116% this quarter compared to 108% a year ago.
Yeah, and you should really think of DBNE as a pure loyalty and adoption gauge.
Okay, how's that?
Well, a 116% DBNE means a cohort of customers who spent, say, $100,000 on Twilio last year didn't just renew their contracts. They found new use cases, added new software products, and spent $116,000 this year.
Got it. Though, to be perfectly precise, about 5 points of that 116% figure is artificially lifted by those same zero-margin carrier fees.
That's a fair point, yeah. But that still leaves a core expansion rate well over 110%.
Right.
It shows the whole land and expand software model is working exactly as designed. You know, a customer lands by using Twilio for simple SMS alerts, and a year later they've expanded into routing their entire cloud contact center through Twilio Voice.
And what's wild to me is how much of this expansion is happening without a sales rep ever picking up the phone.
Oh, the self-serve channel.
Yeah, Twilio's self-serve channel grew over 30% this quarter. Back in May, they launched a totally redesigned developer console.
Right, I remember that.
And they are now reporting a 90% plus uplift in conversions compared to the old interface.
Which is massive. I mean, if you've ever built software, you know the developer experience is everything.
Oh, for sure. If it takes 3 hours and a dozen support tickets just to provision a phone number and get an API key working, developers will just abandon the platform.
Exactly. By removing that friction, Twilio is directly translating user experience into a 90% boost in self-serve revenue.
That's incredible.
And that reduction in friction also extends to their ISV channel, the independent software vendors, which grew over 25%.
Okay, so that's when a company like HubSpot or Shopify embeds Twilio into their own software to handle notifications.
Right, Twilio is essentially drafting off that ISV's growth. Every time HubSpot signs a new client, Twilio's volume goes up automatically.
Nice.
But, we really have to connect this back to those carrier fees. Because while the self-serve and ISV volumes are legitimately growing, the pass-through fees inflating the top line are actively distorting the profitability metrics down the income statement.
Yeah, let's dive into those margin dynamics, because if you are just glancing at a stock screener right now, you are looking at a mirage.
A total mirage.
Non-GAAP gross profit hit a record $736 million, up 18%. But the non-GAAP gross margin percentage actually dropped 160 basis points, down to 49.1%.
And management admitted that the drop is entirely due to those carrier pass-through fees.
Right.
It's a purely mathematical penalty. I mean, if you add $71 million in revenue that carries zero associated profit, your overall profit margin percentage mathematically has to shrink.
Even as your total gross profit dollars reach a record high.
Exactly. If you back out those carrier fees, Twilio's gross margins actually expanded by 60 basis points year over year. The core software margin profile, like the actual money-making engine, is getting more efficient.
Despite what the headline percentage implies.
Right.
Which brings us to the most ridiculous distortion in this entire earnings report.
Oh boy, the GAAP number.
Yeah. If you pulled up Twilio's GAAP earnings per share, it printed at a jaw-dropping $6.68 per share.
Yeah, it's wild.
And we just said their operational non-GAAP EPS was $1.47. The massive gap between those two numbers is a $944.1 million non-cash tax benefit.
Basically $5.91 per share in pure accounting noise.
Exactly. So walk us through the mechanics here, because if you're trying to figure out how much actual cash this business generated, a $1 billion paper credit is totally useless to you.
It really is. It requires getting into the mind of a corporate accountant for a minute.
Scary place.
Very. So when a company operates at a net loss for years, which Twilio did during its hyper-growth phase, they accumulate deferred tax assets.
Okay, so these are essentially IOUs from the government.
Yeah, tax credits they can use to lower their tax bills in the future. But accounting rules dictate that if you are a chronically unprofitable business, you can't claim those credits on your balance sheet.
Because you might never use them.
Exactly. The accountants force you to apply a valuation allowance, which is just a fancy way of saying you might never survive long enough to make a profit, so we are writing these tax credits down to zero.
They basically assume the credits are worthless until proven otherwise.
Right. But Twilio has now proven sustained U.S. profitability over a rolling 3-year period. So the accounting rules flip. Twilio is now required to release that valuation allowance. They are officially signaling to the market, we're going to be so profitable moving forward that we will actually use these billion-dollar tax shields.
And they have to recognize all that stored value in a single quarter.
Yeah, which creates a massive one-time spike in GAAP net income. It's a massive milestone for their business maturity, but it did not put an extra $1 billion of cash into their bank account this quarter.
So to find the actual cash, we have to look at the operational metrics. They delivered a record free cash flow of $353 million, which is a 24% free cash flow margin.
Alongside a record non-GAAP operating income of $285 million, sitting at a 19% margin.
That's solid.
It is. That $353 million in free cash flow is the number that really matters. They are taking this massive global telecom routing business and converting a quarter of every dollar they touch into hard cash.
And the reason investors are cheering is that they are doing this while finally wrestling their stock-based compensation to the ground.
Oh, yes. The dilution issue.
Dilution was the ultimate boogeyman for this stock, and really for the entire cloud software sector over the last 3 years.
Seriously.
Companies were essentially printing shares to pay their engineers, diluting your ownership stake to death, and then bragging about their adjusted non-GAAP profits.
Right, playing games with the numbers.
But this quarter, Twilio's stock-based compensation dropped to 9.5% of revenue. That is down 270 basis points year over year.
And breaking below that 10% threshold is really critical for institutional investors. For years, Twilio used its stock buyback programs just to offset the dilution from employee stock grants.
Just running on a treadmill to keep the share count flat.
Exactly. Now, with SBC under 10% and the company generating $353 million in hard free cash flow, the treadmill is turned off. They have $826 million left on their current share repurchase program. They have the actual cash power to go into the open market, buy up shares, and actively shrink the float.
So every share you own represents a slightly larger slice of the pie.
Exactly.
That is the textbook transition from a zero interest rate growth at all costs story to a disciplined capital returning machine.
It really is a textbook case.
But, cash flow discipline and share buybacks don't typically pop a mid-cap tech stock 25% in a single trading session. To get that kind of multiple expansion, you need a forward-looking narrative.
And right now, the only narrative Wall Street cares about is artificial intelligence.
Right. Here's where it gets really interesting. Management spent a massive portion of the earnings call positioning Twilio for what CEO Khozema Shipchandler coined the hybrid agentic era.
The term agentic era is meant to describe the shift from chatbots that just answer questions to AI agents that can actually execute tasks.
Which sounds great, but what does it actually mean for Twilio?
Well, Shipchandler's vision is a hybrid ecosystem where human customer service reps work seamlessly alongside autonomous AI agents, handing tasks back and forth.
Okay.
And Twilio wants to be the underlying infrastructure that connects both the human and the AI to the end consumer.
They back this up by rolling out a new conversations layer, featuring tools like Conversation Memo, Orchestrator, and Intelligence.
Right.
But what actually caught the market's attention was a tangible return on investment case study. A UK-based auto fintech company called Car Finance 24/7 used Twilio's new tools to build an AI assistant named Carla.
And Carla put up some serious numbers.
She really did. This AI handled 288,000 customer conversations in the quarter, and customers who engaged with the AI agent converted into approved sales leads 1.6 times faster than those who went through the traditional funnel.
A 1.6x acceleration in a sales funnel translates to massive, measurable top-line revenue uplift for the client. That is exactly what the market is desperate for right now.
Because investors are exhausted by enterprise software companies just talking about how much capital expenditure they are sinking into training AI models, right?
Yes. They want to see companies proving that deploying AI actually generates hard ROI for the end user. Car Finance 24/7 proves that Twilio's AI tools actually drive sales, not just operational efficiencies.
And Shipchandler was incredibly deliberate about Twilio's role in this ecosystem. He positioned Twilio as the neutral middleman.
Like the Switzerland of AI.
Exactly. They aren't trying to build a large language model to compete with OpenAI or Google or Anthropic. Think of Twilio not as the intelligence, but as the universal power adapter.
That's a good way to put it.
Right. You've got an AI model built in Europe or one built in California. They are generating the electricity. But you still need to plug that intelligence into a consumer's 10-year-old smartphone via an SMS text.
Or into a legacy hospital call center.
Right. Twilio is the adapter that makes the connection work, regardless of which model you use. And let's play devil's advocate for a second.
Okay, let's do it.
The story sounds bulletproof, but is anyone actually paying for these specific AI features today? Or is management just playing buzzword bingo to inflate the stock price?
Management was surprisingly grounded about the timeline here. Shipchandler explicitly stated that AI adoption is still in the very early innings.
Okay, so it's not driving the massive revenue beat today.
Not directly from raw AI compute features en masse, no. The revenue spike is actually driven by massive cross-selling of their core products to AI companies.
Right. They highlighted an 8-figure deal signed with the leading unnamed AI company this quarter.
Exactly. Plus 7-figure deals with companies like TWLO and L3P. These companies are building sophisticated AI tools, but an AI model sitting in a data center is useless if it can't communicate its output to a human being.
Right. They have to buy Twilio's core messaging, voice, and verification APIs to actually route those AI-generated answers to users' phones.
Exactly. The universal adapter strategy is brilliant because it entirely future-proofs Twilio. Well, if OpenAI is the dominant model today, Twilio routes their traffic. If an open source model takes the lead tomorrow, Twilio's customers just swap the model on the back end.
Ah, and they still have to pay Twilio's toll to send the text message.
Precisely. Twilio monetizes the communication layer, totally insulating themselves from the bloodbath of the compute layer arms race.
That makes a lot of sense. But, that neutral middleman strategy assumes the underlying foundation remains stable.
And as we dig into the risks buried in this report, the foundation definitely has some cracks.
Yeah, if you are evaluating this stock based on a long-term AI infrastructure play, you cannot ignore the execution hurdles that are flashing right now. We have to talk about the absolute ghosting of the Segment business in this earnings print.
It is the glaring omission of the quarter, without a doubt.
Back in 2020, Twilio spent over $3 billion acquiring Segment, which is a customer data platform.
Right, and the thesis was that Segment would act as the central brain, holding all the customer data, feeding intelligent context into Twilio's communication pipes.
But in this quarter's press release, there is zero standalone financial data for Segment. I mean, management previously warned they were going to stop focusing on it as a standalone unit, but the total opacity here is alarming.
It really is.
When a company pays $3 billion for an asset and then actively stops reporting its specific growth metrics, it is never because that unit is outperforming expectations.
Never.
Are they just burying a massive failure underneath the sheer profitability of the core messaging business?
That is the most logical conclusion. From an analyst perspective, it creates a massive blind spot. The core communications business is undeniably humming, but you have to assume the Segment division remains a drag on overall consolidated growth.
Right.
It makes the 17% organic growth of the total company even more impressive, because it implies the core business is growing fast enough to offset Segment's drag.
But it doesn't erase the reality of a multi-billion-dollar sunk cost that hasn't delivered on its original synergy thesis.
Yeah.
And speaking of sunk costs, there was a quiet, highly specific line item tucked into the GAAP financials. A $33 million prepaid asset impairment.
Yeah, that was an interesting one.
Basically, Twilio prepaid for network routing services with two telecom providers. They eventually realized they were never going to utilize $33 million worth of that capacity, and they had to write it off as a loss.
And management kind of brushed it off by noting it won't impact future free cash flow.
Which is technically true, right, because the cash already went out the door in a previous quarter.
Right, but it is a stark reminder of the physical realities of cloud communications. Twilio doesn't just exist in the cloud. They have to negotiate and prepay for actual physical telecom infrastructure capacity globally.
And when demand forecasts are slightly off, it results in real capital inefficiencies.
Exactly.
And we are seeing an interesting divergence between the people running the company and the people analyzing it. Simply, Wall Street pointed out a stark contrast this week.
Oh, the insider selling.
Yeah. On one hand, you have peak analyst optimism. Wall Street is frantically raising price targets to $270, $280, upgrading the stock across the board.
Right.
But simultaneously, there has been a noticeable increase in insider selling. Now, executives sell shares for dozens of reasons: paying taxes, buying real estate, basic diversification.
Sure, of course.
But when the insiders closest to the actual network data are taking chips off the table into this massive rally, while Wall Street analysts are pounding the table telling you to buy, it really warrants caution.
It absolutely does, especially when you factor in the structural risk we unpacked earlier.
Yeah.
Those rising telecom carrier fees.
Right.
The major carriers see how much money Twilio is making by routing traffic over their networks, and they are steadily raising the toll to send A2P texts.
And Twilio protects its own gross profit dollars by passing those fee hikes directly to the customer.
Yes, but that dynamic slowly crushes the margins of Twilio's smaller SMB customers.
If the toll to send a text message keeps going up, a small dental office or a local restaurant can't afford to run SMS marketing campaigns anymore. They just get priced out of the ecosystem entirely.
Exactly. They are forced to migrate to cheaper internet-based channels like email or WhatsApp.
And Twilio does support WhatsApp routing, but the unit economics and the margin profiles are different.
Very different. A mass exodus of small businesses away from traditional SMS could pose a serious threat to their high-margin volume growth over the next 3 years.
Not to mention, management themselves explicitly warned that they're facing much tougher year-over-year comparables in the second half of 2026.
Oh, definitely.
The 17% organic growth this quarter looked fantastic, partly because they were comparing it to a weaker period in early 2025.
Yeah, maintaining mid-teens organic growth in Q3 and Q4 is going to require near-flawless execution.
Right.
The bar has been permanently raised.
So they can't just coast.
No, they can't rely on easy comps anymore. They need significant, measurable adoption of these new AI-driven conversation tools to maintain this growth trajectory.
So when you strip away the billion-dollar tax illusions and AI buzzwords, how do you evaluate TWLO today?
That's a complex picture.
The reality of this deep dive is that Twilio has successfully executed one of the hardest maneuvers in software. They transitioned from a bloated, growth-at-all-cost pandemic darling into a highly disciplined, cash flow-generating machine.
Very true.
They are producing real operational cash, reining in stock-based compensation, and actively shrinking their float. But the true revenue upside from the AI boom, the justification for the massive valuation multiple the market just handed them, remains a longer-term play.
Right. It depends entirely on their ability to execute the agentic vision over the next 24 months.
Exactly.
They have proven beyond a doubt that they have the financial discipline. The next phase is proving that their product vision as the universal adapter for AI is something enterprise customers are actually willing to scale rather than just pilot in small beta tests.
I want to leave you with a final thought to mull over as you watch this stock. Twilio's entire bull case rests on the premise that they are the neutral infrastructure, the adapter connecting all these diverse AI models to all these different communication channels.
Right.
But what happens if the tech giants decide they are tired of paying a middleman? If companies like OpenAI, Salesforce, or Microsoft decide to vertically integrate and build their own communication pipes directly into their AI platforms, Twilio's moat suddenly looks a lot shallower.
Does Switzerland get invaded?
Exactly. If you are banking on the universal adapter strategy, you have to ask yourself, what happens when the device manufacturers decide to change the plug?
That vertical integration threat is the existential question that will define the next decade of cloud software infrastructure.
Keep an extremely close eye on those carrier fees and watch the quarterly cash flow statements to ensure that $353 million actually translates into aggressive share repurchases. Make sure to follow the show for daily earnings coverage and real-time breakdowns of the market's biggest moves.